Hello, this is Dale. The topic of this video is going to be when to exit a trade. I've been a trader for over 35 years, hedge fund manager, been a guest speaker on a number of platforms, written 3 financial books, and I am the founder of what I believe to be the very best stock option Forex education website available today. That is www.optionsinfinity.com. I am the stock option coach. I don't teach because I haven't done. I have done this for 35 years. This is how I've made my money. At this point in my career, I get a big kick. I have a passion for working with people to help them become successful in this very difficult arena. Most stock market literature focuses on the trade entry. If you look through all the literature online, you're going to see how to enter, how to use this indicator, that indicator to get into a trade. But exiting the trade is what will define your success. And I've adhered to that for many years, and it is indeed a fact that if you know when to exit, you can do very, very well. Of course, the old adage is you want to cut your losses short and let your profits run. So you want to know when to take those profits. You just don't want to let them run and have them run out of steam and lose some of that hard-earned money back. So not only knowing when to exit, but exit when the time is right, when the movement has exhausted, is very important. My trading strategy has 2 exits for losing trades, 1 exit for losing trades and 1 exit for profitable trades, or 2 exits. And I adhere to this. First of all, when I have a measured move that goes opposite the trade, and I'm gonna define a measured move for you later on in this video, I go ahead and exit the trade. That usually is going to be a losing trade when I get a measured move opposite. However, I'm going to cut my losses short and let my profits run, because when I've got a trade that's running with me, I'm going to wait till it gets up to around the Fibonacci's, the 127 or the 161, and preset that as a target to book my profits. I'm going to explain in great detail measured moves and Fibonacci's later in this video. Now, with the exit strategy, you can make money independent of the entry. I've run this experiment many times, and what I'm going to show you is trades that I took with random selections on the entry and just with an exit strategy, and that they ended up profitable. The chart we're looking at here is the Standard & Poor's 500, and I'm looking at the last 2 years, and of course the market has been bullish. You can see this green line. The green line is what's called the regression line. It is calculated with 50% of the price above and 50% of the price below. This actually was more bullish before the coronavirus scare hit, but it still remains bullish over the last 2 years. So what I did is I took 3 random dates and 3 random stocks. One was a Forex. It was the US dollar Japanese yen pairing. And I was able to show a profit independent of the entry. So 3 random dates, 3 random stocks, 1 Forex, 2 random stocks and a Forex. The first thing I did is I put on bullish trades because the trend, the long-term trend, was bullish, even though with the coronavirus scare, it's kind of leveled things off. I went in with bullish trades. The first one was Amazon, and the random entry I chose out of a hat basically was March 23rd, 2020. Okay. We were actually recovering a little bit after the corona scare. This is March 23rd right here, right in here. Okay. And at that point, Amazon was trading at 1847. I went in with a bullish trade. And what I was looking for is a measured move, which is a lower high and then a higher high. That defines a measured move, a bullish measured move. Once I have that measured move, and I'm going to explain that in great detail later, once I have that, I can put on Fibonacci's. And usually the Fibonacci, the 127 and the 161 are the ones I look at. In this particular case, it went strong through the 127 up to the 161, and I decided to take profits right here. Exit on a 161 Fibonacci extension. It was April 16th of this year at 23.46. That was a 27% profit straight. The second random entry I took was on the US dollar Japanese yen Forex pairing. And what I did on this random date, this was 2/7/2020, before the corona scare. And it happened to be this point right here. Excuse me. So I went in and there was a measured move. Remember, a measured move goes from the low to the high, then down, it pulls back to a lower point here, which is a higher low, and then a higher high. Once I have that, I can put in Fibonacci's automatically. Most trading platforms can do this automatically for you. I use Thinkorswim. I'm not affiliated with them, but I happen to think they're an excellent trading platform. Once you lay in the measured move, it automatically gives you the Fibonacci extensions. So I got in right here, randomly, got out right there, got in at 109, got out at 112. That's 300 pip profit, which is a huge profit in the Forex pairing. The last random test that I'm going to show you, I did on Costco. And for this one, I went all the way back to August 5th of 2019. And here is the random date. At that point, Costco was sitting at 264. It actually came, this was the low, came up and made a high, and then it pulled back, but this is a higher low, and then it made a higher high. So I can automatically put on the Fibonacci's. Here's the 161. So I exited in less than a month on August 27th at 293. Less than a month, straight up, made 11% profit on a random entry following the exit rules. Okay, the next thing I want to do is just take a look at 3 of the more popular ways that people sometimes look at when to exit. Sometimes they use the MACD crossover. We're going to take a look at a 3-day trailing stop. And then I'm going to look at when it crossed over the 20-day moving average. The first one is the MACD crossover. And you can see the MACD crossed over here. That would have been an entry point. So I kept that entry for all the charts here. And it didn't cross back over until right here And what's interesting about this is you made profit, you made profit, you made profit, and then you gave it all back because you waited for the MACD crossover to get out of your trade. Well, let's take a look at a 3-day trailing stop. Okay, a 3-day trailing stop is always looking at if this was the day, 1, 2, 3, this was the low. So as long as it stays above that low, I'm in there. So I was in there here. You can see that I'm in, this is the low here, and I'm in there for that. And then we come to this day here, which is lower than this low on the 3rd day. So using a 3-day trailing stop, I got out quicker than I did with the MACD crossover, but still I gave back a lot of the profit that I had made. Well, the last one is the 20-day moving average. And it's interesting because the 20-day moving average is actually right about exactly where the 3-day trailing stop showed up. Once again, we gave back some profit that we had made with these 3 popular exit indicators. There's the Fibonacci, the 261 Fibonacci. So what you're doing with the Fibonacci is you're looking at this trade and saying, hey, we're overextended on this trade. Maybe it's time to take some profits. And you can see that taking profits when the trade is going in your direction, going in this case up, and getting out is better than letting it come back and revert back. A lot better than this one, and this one. Okay, so let's dig into how you come up with Fibonacci extensions. The first thing we need to do is understand and apply measured moves. A measured move is when the price is down, it makes a low, then it comes back up and then pulls back, but does not come all the way down below A. So it's making a higher low. Then it continues on and makes a higher high when it crosses over the B point. This is called a bullish measured move. And the classic definition of a trend, an uptrend, is higher highs and higher lows. As long as the trend stays with bullish measured moves, you are in a bullish trend. Now, a bearish measured move, excuse me, is just the opposite, where the price is up, then it comes back down, it pulls back, but makes a lower high, and then makes a lower low when it crosses below the B point. That is a bearish measured move. And the classic definition of a downtrend is lower lows and lower highs, a continuing lower low, lower high. And as long as the trend stays that way, you can stay knowing that it's in a a bearish trend. These are 2 very powerful pieces of information to determine when a trend might be changing, and can you stay with that trend to continue to make money? Here's an example of a chart of Bank of America. You can see that it was coming down. This was the low. Then it came back up. It pulled back, but the low here was higher than the low here. So we had a higher high, higher low, and then we made a higher high. So that is the classic measured move at that point. Once you're in there, you realize that the downtrend has changed and we're now in an uptrend. Now, what's interesting as we look further, it came up here, it pulled back, it made a higher low, and then made a higher high. So this uptrend is continuing with the second measured move. Now, what I was saying on Thinkorswim and most of the platforms, when you have a measured move, you can immediately put on Fibonacci extensions. If you click here, come up, click here, and pull back and click, it's going to apply Fibonacci extensions at the 127, the 161, and the 261. And as a rule of thumb, is at the 127, if it blows through there, there's a good probability it's going to go to the 161. If it blows through that, there's a good probability it's going to go to the 261. And that's exactly what happened here. I don't show you the 127 and the 161, but they were right around here. And this big up day blew through both of those. So you anticipate that the next time we might get a halt or have this overextended is at the 261. And sure enough, it did. It came right up here. Now, the Fibonacci extensions are uncanny. I have seen the markets come to within a tick of the Fibonacci extensions and pull back. And you wonder, well, why? Why does that happen? I'm going to get into that in just a second. Fibonacci derived a number sequence way back when. And what he did is he adds the current number to the previous number to get the next number in the sequence. 1 plus 1 is 2. 1 plus 2 is 3. 2 plus 3 is 5. 3 plus 5 is 8, and so on and so forth. Okay. And if you divide any of the numbers by the previous into the previous number, you get 1.618, which is called the root Fibonacci ratio. Now, along came mathematicians and they take the square root of that and they look at the square of that. And these are used for retracements. And a lot of people look at Fibonacci's and use retracements only. When I was taught many years ago, I was taught to use the extensions, not the retracements. The extensions are a little more accurate. They show you when a trade is exhausting itself. And what mathematicians did is they took these and they look at the reciprocal of these, and there's the 127, the 161, and the 261. These are the numbers we use for extensions. Now, Fibonacci's are seen everywhere. As you go up the stem of a flower, the leaves grow at proportion distance to the golden ratio. The spiral of seashells are in proportion to the ratio. If you look at all the bones in your body, they grow proportion to the golden ratio. My forearm is 12.3 inches measured from the crease by my elbow all the way down to my wrist. It's 12.3 inches. My hand from the wrist to the forefinger is 7.5 inches. That is 7.5 divided by 12.3, 0.61. That is the golden ratio. So are all your major bones. They all are proportioned to the golden ratio. This is seen throughout nature. So doesn't it make perfect sense that the stock market, which moves because of human fear and greed, doesn't it make sense that it would move in perfect harmony with nature? And I think that's why you see the price of something going up and just stopping on a dime and reverting back. It's a very powerful tool. The measured moves and the Fibonacci's, they used together, they will help you establish when to take profit in a trade. Now, the Fibonacci extensions may be used on any time frame. If you're looking at a week chart, if you're looking at a daily chart, if you're looking at a 5-minute chart, you can put on Fibonacci extensions based on the measured moves. They can be used in any market. They can be used when the price is going up or going down. It's a very flexible and very powerful tool. So what I'm going to show you is 3 examples. One is an Amazon chart, and that was a week chart. The other is the SPX, Standard Poor 500, daily chart. And then I'm going to take a look at a 30-minute Forex chart. So the first one we'll look at is Amazon. And there's actually 4 parts here that I look at this chart. The first one, let's start here all the way on the far left. It comes down, it makes a low right here, comes back up, pulls back, makes a higher low, and then a higher high. And there is the 161 based on this measured move. Pretty doggone close, okay? Now, remember that when it goes past the 127 and it blows past there, which it did, the good probability it's going to go to the 161. Okay, on the downside, it came up to the 161, then pulled back here and made a lower high and then made a lower low right here. The trend changed, and this came all the way down to the 261. It blew through the 127 and the 161. I didn't put these on the chart for clarification. And you say, well, yeah, but it went down even further. I'm okay taking a profit right down here because I know that many times it'll come up very close and then revert back. So it comes down here, and this is the low, comes back up, comes here, makes a higher low, makes a higher high. The 127, because this was a pretty big move, did not occur till after it went through a little bit of sideways gyration. There's the 127. Bam. That's look where it came, to the 127. Now, this was also confirmed when we had a smaller measured move here. This was the low, okay? Pulled back to make a higher low right here, made a higher high right here, and there's the 261 of this smaller measured move coinciding with the 127 of this big measured move. This is a great time to take profits. Well, if you would have, wouldn't have you been glad? Because the Fibonacci shows you when the price movement might be exhausted. Let's look at a daily chart of the SPX. And there's 3 examples here. The first one, this is a big measure move, almost comes down and continues the downward measured move, but it comes up short. It makes a higher low, then comes over here and makes a higher high, comes up, blows right through the 127, comes up to the 161, almost within a tick. You could have gotten out right here. If you waited till over here, it comes up there to within a tick of the 161. Then the trend changes. It comes down, it makes a lower high, makes a lower low, and down it goes. There's the 127 blowing right through there, 161, good time to take profit. Then it changes direction again. It comes up, makes a higher low, higher high, 127. Great time to take profits. So that's a week chart on Amazon and a daily chart on the SPX. That this just works fantastic. Let's take a look at a short-term 30-minute Forex chart. The movement is strong down. Then it comes back up, pulls back here, makes a higher low, comes up to the 127, pulls back a little bit, and pushes up past it, and that's okay. That's okay. Then you have it reverting back and coming to the 127 to the downside, and then the 127 again to the upside. 3 measured moves, one up, one down, one up, profit, profit, profit. This is my return on margin chart for 2019, 2020. And you can see how the equity has gone up, 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 up. You are going to have some losing trades. You're going to have some losing strings. This was because of the coronavirus scare. However, look at what's happened since that point in time. We are right back up and moving on. And I'm expecting a very positive 2020 with everything that's going on. Now, what I'd like to do is go over to my website and show you what I have available to you. The website again is www.optionsinfinity.com. We are celebrating our 10-year anniversary. In those 10 years, we have averaged 75% winning trades per year. If you scroll down, you're going to see a PDF of what I call the 3 principle method of trading. It's a blueprint. The discussion I just made on exiting the trade, if you put that together with powerful entries, now you have a real winner. And that's what the 3 principle method of trading is. I've been doing this for 35 plus years, and this method of trading is a compilation of everything I've done. It's a simple, easy to follow method to profit in the stock market, the options, and ETFs, and Forex. All you do is you come down here and you click on this. You can view it or download it. It's a PDF. Might want to look at a couple of the testimonials. As a matter of fact, let me just go over this one because I'm very proud of this testimonial. I listened to you talk about when the market goes down to hedge your portfolio. See, in my community, I not only teach my strategy, but I teach how to protect yourself when the market goes down, how to trade stocks, how to manage your portfolio. Jahan goes on to say, he's listened to me talk about hedging your portfolio. Well, because of the coronavirus scare, this time I did. A little late, and saved many thousands of dollars, many thousands of dollars. He told me the exact amount, and it was huge. Your monthly fee pales in comparison with the amount of money I've made and saved following you. You scroll down even further, you can see a free video on how does a mentor speed up your trading success. What I'd like you to do is become a member of our community. What I'm going to do is when I see a trade, I send out text and email alerts to you directly. So it's like you're looking over the shoulder of a professional as I go about my business of trading the markets. I'm going to send you the text and email alerts. What I would suggest is you go onto your chart, you look at it. If you see that it makes sense to you, go ahead and make that trade. I talk about how much you should put on a trade so that you're being conservative and you don't over invest, which is a common mistake people make. Once a week, we get together on Tuesday afternoon at noon Eastern time. If you can't make it, these are recorded and posted on the website. These are taught by me. I usually go over a lesson. We then look at all the trades we have. I talk about how I'm managing those trades. And then there's always plenty of time for questions. You also receive the entire master suite, which talks about how I trade Forex, how I trade options, how I trade stocks. So this package is a very powerful package for you to earn while you learn. Now, if you'd like to continue your journey and get a little more education about me and my methods, what I'd like you to do is go ahead and click on my YouTube channel, the big green circle. I've got over 20 videos in there, educational videos. And I would suggest you click on the video I'm now showing on the right-hand side of the screen, and that'll take you to part 1 of how I actually put on and exit my trades. Good trading, everyone. I hope you join me. Bye-bye now.